Whole life insurance. You probably have one. It was common practice back in the day for grandparents to buy their grandchildren a policy. I mean, if you go back to the Depression era, a lot of times those people back then, that's what they put their money in. They put their money in whole life because they got wiped out by the stock market during the Great Depression. Whole life was the one steady, the one solid. I mean, and that can be proved by looking at Walt Disneyland. Walt Disneyland was started by Walt Disney by taking a loan from his New York Life policy. It's a fact. And a lot of businesses during that time needed extra liquidity and extra capital. And where'd that money come from? Whole life insurance. So that era was a commonplace for whole life. But the whole life policies that were started back then, a lot of times they were like $10,000, maybe $15,000 would be a bigger policy that was started back then because times have changed. Back during that era, $10,000 was a lot of money, and that's how much the death benefit was. So let's fast forward right to where we're at today. Whole life insurance doesn't have a good reputation. It doesn't have a good reputation because we've been in the longest bull run in history where people have made a lot of money in the stock market by investing in stocks, mutual funds, and ETFs. But all things are cyclical, and that will not continue. And when it doesn't, when we enter another downturn, another cyclical cycle, we call it the winter season, where the markets go down and we enter a recessionary period, whole life will all of a sudden become very popular. Why? Well, because it's the true steady Eddie, the guaranteed place where you can put money. But see, what I wanted to do in today's video is not to just talk about that. I want to talk about how could you use a normal whole life insurance policy that you've maybe had 10, 20, 30 years that you never used for anything other than, well, it's a death benefit that'll pay for my burial. How can you use that? Well, that's what we're going to hit today. So one of the things I want to start with before we dive into regular whole life policies and how they can be used is I want you to all understand the difference between what we design, the specially designed and engineered whole life policies, and what you might have, which is a normal off-the-shelf whole life. The biggest difference is, just like I said, design and engineering. So when we design and engineer the policy, it really comes down to how your premium deposits are allocated. Your old whole life that you probably have, and I have one too, and this is where we're gonna talk about my old whole life right here. We're gonna talk about how they're built. And then I'm gonna show you the differences and how we design them for high early cash value so they can be used for the infinite banking concepts. Some of the fundamental features that can be found in all whole life are these. Number one, all whole life policies have a guaranteed interest rate. It's in the contract. The old policies, like the ones that you would probably have from back when, are gonna probably be at a guaranteed 4%. That was pretty much the standard across the industry. This policy that I have, which was started in 2008, right here from New York Life, is a 4% guaranteed interest, which can be found right in your contract. It's printed. That 4% interest in the old policies does not change. It never goes up, it never goes down. It's contractually locked at whatever your contract says it is. Now, some of you might even have really old policies that are more than 4%, but I only know the ones that were 4% because I only know policies from 2003 up to current. Now, a few years back, there was an IRS change, it was called 7702, that gave the insurance companies the ability to reduce the guaranteed interest rate. So policies that we design and engineer today have a guaranteed interest rate of between 2 and 3.5%. Not much different than what it was when it was at 4, but still lower. But the dividend crediting rate is the exact same before as it is today if we were to compare. Now, dividends do change. They go up, they go down, and recently dividends have been going up. So a policy from a few years ago, you'd be earning a higher dividend crediting rate today. So what are the similar features between specially designed policies and regular policies? Guarantees, okay? That's the first thing. But the second thing, and I think the most important thing, and the number one reason whole life insurance is the only policy designs we use for the infinite banking concept is this. The cost for the death benefit, they call it cost of insurance or COI, is level. This is very important. Let me just repeat that. The cost per $1,000 of life insurance death benefit is level. So what does that mean? Well, that means if your grandparents bought you a policy back when you were 10 years old, there was a cost of insurance that was established when you were 10 per $1,000 of death benefit. That cost has not gone up even if you're 50 years old today. The cost is identical. So it's almost like you're 10 years old from a cost standpoint for the death benefit. That is so vital. Because all the other policies you're going to find out there, universal life, IULs, which are commonly known as indexed universal life, variable universal life, or VULs, and term insurance, all have an increasing cost of insurance. In other words, as you get older, your likelihood of dying increases. That's just mortality for you. The older we get, the closer we get to the day we graduate. So as we get older, those other policies, not whole life, but those other policies will adjust the cost to be reflective of your age. The older you get, the higher it costs. Term insurance is no different. You might lock in your cost of insurance for a period of time, but after that, it increases. How do I know? Well, if you had a 10-year term policy, your cost was exactly the same for the 10 years. But in the 11th year, if you wanted to continue or redo it, your cost would skyrocket because you're 10 years older, which means your cost went way up. So a whole life insurance policy, whether it's specially designed or regular, has a level cost of insurance, meaning the older you get, it does not change the cost structure of the policy, meaning you have a very predictable growth pattern in the policy. Your interest rate on the policy, the guaranteed interest rate, remains exactly the same. Your cost for the death benefit remains exactly the same. So because you have a guaranteed interest rate and a guaranteed cost of insurance, you have a vehicle that works incredibly well and can be predicted very closely into the future. That is not the case with IULs, VULs, or even universal life policies because they all fluctuate with either interest rates, market performance, or participations in an index, which is vital. Let me go one step further with whole life insurance and what makes it so unique, whether it's specially designed or regular. It has been around for a very long period of time. It's the original OG. It's what life insurance was back in the day, folks. They didn't have all these fancy life insurance. They had whole life. So when the Rockefellers and Rothschilds and the Morgans and the Stanleys all came together and kind of started using whole life as a banking mechanism, privatized banking systems is what they like to call them, they could use whole life because of that guaranteed nature and that guaranteed cost structure. So they could predict things out, which is what bankers like to be able to do. Now, in today's world, you got a lot of people slinging around a lot of products because they say that they're better. They say you're gonna make more money. That's all hypothetical, folks. That's all if and only if these specific things happen. If the market does this, if the index does this, if your participation rate is this. But they can illustrate them to look as good as they want, but that does not mean that's what you're going to get. That doesn't mean that's what your cash value is going to be. That doesn't mean that's what your death benefit is going to be. It's all hypothetical. In a whole life, it is what it is. So when we design and engineer a whole life, all we're basically doing is we're reducing the death benefit. We're literally going into the policy and we're deciding how much of the premium deposits we want to go to the base whole life and how much of it we want to go to a special rider called a paid up additions rider, which the paid up additions rider is how we get the high early cash value. Think of it like this. You've got money in your right pocket, okay? You got your money in your right pocket, but your left pocket sends you a memo saying that it will pay you more interest than your right pocket does. What would you do? Well, you would very logically take the money out of your right pocket and you would put it into your left pocket because your left pocket's going to pay you higher interest. The paid up additions rider is that left pocket. It allows you to take money, put it into this rider and have instant liquidity of that money. At least 90%, sometimes even a little bit more. You have access to that money immediately. So the more money we put into that rider, the more money you have instant liquidity of. However, we can't put all the money into the paid up additions rider because of the IRS rule. So when we design and engineer it, there's a balance, a very delicate balance of how much we can put into the paid up additions rider, anywhere between 60 and 90%, and how much we have to put to the base whole life, that level cost of insurance part, that death benefit, okay? We have to have some of that money there because of the IRS rule called the MEC 7-pay. You can Google that. Actually, just go into Google and type in MEC, M-E-C, 7-pay rules, and that will give you the explanation. So let's talk a little bit about the base. Because a lot of people, when they learn about the specially designed and engineered, they want all the money into the paid-up additions because they think that's better. But see, that's where they're wrong. And that's where I want to really give all of you that have those old, normal, off-the-shelf, whole life policies some credit. Because in the later years of a policy, usually after year 8, 9, or 10, depending on the policy, the base becomes way more efficient for growth than the paid-up additions. The paid-up additions riders are great in the beginning. They give you instant and immediate liquidity, high early cash value, we call it. But in the later years, the base is what matters. And I'm gonna prove that to you. So why don't we do this? I think the best way to show this so that any of you that have an old whole life will know kind of how to do this on your own statement is just to walk through one of my old policies. You see, when I was a financial advisor, I started a couple whole lives for myself. This is just one of the 2 that I started. This policy was started in 2008, which surprisingly is 16 years ago. But let me walk you through the statement so you can understand what an off-the-shelf, normal whole life insurance policy could look like. Now, mine may differ a little from yours because this is a limited pay. If I'm not mistaken, this was a 20-year period certain, which means I only pay premiums for 20 years. And then after that, I can't put money in anymore. But I wish I could put money in for way more than 20 years, and I'll show you why in a second. But if your policy allows you to continue to make premium deposits beyond a certain date like mine, please make the premium deposits. And I'm gonna mathematically show you why that makes sense. So I'm gonna put my glasses on. Let's walk through this thing. So again, this is a off-the-shelf, 100% base whole life insurance policy. And then this is with the company I used to be with, New York Life, okay? As you can see here, New York Life custom whole life with 20-year premium payment period. I just blacked out the agent and I blacked out my policy number. But down underneath that, you can see I had a face amount. My death benefit was $250,000. The way we design them when they're custom designed, the death benefit's gonna be a weird number. It wouldn't be ever a flat $250,000 because of the way we design them. We're putting the lowest death benefit. But this is how we did them back when I was an advisor, and more than likely how whatever old policy you have was designed. My premium payment was $389.06. I paid $4,407.50 each year, and I've done that for 16 years, okay? So let's get into the numbers though. The first thing I think is very important to call out is when you look right here at the total death benefit. The total death benefit on this policy is not $250,000 like it was when it started. It is $287,769. You see, the death benefit has gone up because each year New York Life has paid me a dividend. And each year I've gotten that dividend, I've effectively reinvested that dividend back into the policy through that paid up additions rider. More than likely, your old policy is exactly the same because that was pretty standard. Unless you're getting a check every year for the dividend or using your dividend to offset your premiums, and if you are, change that back, you would want your dividends to go to paid up additions, which mine is. So my death benefit has gone up quite a bit, $250,000 to $287,769. But for banking, for the infinite banking concept, I don't really care as much about the death benefit, but it still matters. But now let's look at the cash value. My policy has a cash value as of June 1st, 2024 of $90,408.53. Now that number in of itself means absolutely nothing because you don't have a reference point as to what that means. But I do have a reference point, and I just want to show you really quick. This is the policy from a year ago. A year ago, my cash value was $81,976.38, of which you can see I put $4,407 in. So if I had $81,976 in it then, and I added $4,000, so that would be 81 plus, let's just do the math real quick, shall we? I don't want to make a number up because that's gotten me in trouble before. So 81,976.38 plus the premium, $4,407.50 right there. $86,383.88. Now let's come back over to my new policy. My new policy is $90,000. So if I subtract that from the 87, that means my net growth is $4,024.65. Forget about the negative, I just did the math differently. So I made $4,024 in 1 year on this policy. But you see, I did the math a little differently for you, and I want to walk you through. So 2024 dividend was $1,710, but I like this part. Read this with me. During the past year, your base plan guaranteed cash value increased $6,352.50. So I put in $4,407, but I increased $6,352.50. From $70,100 to $76,452.50. In addition to this increase, the annual dividend, so the dividends on top of the guaranteed interest, was $1,710.62. So now this gets really fun. This is a normal off-the-shelf whole life, but this is 16 years, okay? This is 16 years of uninterrupted compounding growth. Now, one other thing that's important for me to bring up here is I've never not used this policy. I have used this policy to pay off debt. I've used this policy to buy multiple cars. I've used this policy to lend money on real estate. I've used this policy to buy real estate, renovate houses, flip houses, all sorts of stuff. I've used this policy to make sure that I could make payroll, for crying out loud. I've used this cash value the entire time, but yet I haven't missed a beat. That's because even when I use the money, I'm still earning interest and dividends on all of it. This is living proof right here, folks. This policy does everything that I teach because it is a policy from a mutually owned, dividend-paying whole life insurance company from New York Life. But let's just add this up. And I did the math for you, so take a look right here. I just did the math. I went in and I said the interest that I earned was $6,352.50. The dividend I earned was $1,710.62, as you can see. That means I made $8,063.12. But if I made $8,063.12, I would have to subtract the premiums that I put in that year, because you want net numbers, right? So if I subtract the $4,000, that was what I made. Okay, so let's just do that real quick because I did it a second ago. So if I do that, if I made $8,000, and I'm just trying to, this might be a bit monotonous to some of you, I made $8,063.12. But I also put premiums in of $4,007.50. So if I look at it, that's how I came up with that $3,655.62, which is my net growth. Net of commissions, net of policy service fee, which I think New York Life's $100 a year, and net of cost of insurance for that $287,769, and yeah, that's net. Okay, now, why is that number important? Well, that number allows us to come up with a return. Now, there's two types of returns you can look at with any whole life policy or any investment you do for that matter, or any account you have. You can do a cumulative return, which would, let me just define a cumulative return. A cumulative return would be where we add up the premiums every single year that we put in. I did that over here. $4,407.50 times 16 years. So I put in $70,520 into the policy. But my cash value is $90,408. So my cumulative growth was $19,888.53 over 16 years. So to figure out your cumulative return, and you would do this with a 401k, an IRA, you could do this with any account, is you would divide that growth right there, okay? And you would divide that into the total amount you paid, the $70,520. How much is my cumulative return in this policy year, 16th year? 28.2%. This guaranteed whole life policy has made me 28.2%. That's the cumulative return. So that's the first kind of return. But before I get to the second return, which is called cash on cash, let's do a little exercise that I think will be very beneficial for you. And it is called click that button called subscribe. And there's a little bell up top. The bell kind of looks like this. Well, not really. It's a bell. And all I want you to do is I want you to smash. Man, that always sounds worse than it is. Smash that bell so you're notified every time I put out a new video. And I'm putting another video out that I think you're gonna like a lot. And it's a brand new remastered 90-minute video. I'll post that at the end of this video. But let's dive back in. So we went over the cumulative return, which was the first way you could figure out a return. Now, why would a cumulative return be important? Well, a cumulative return would be important because it would mean that you put money into something and you never touch that money. You just let it sit there and build and build and build. You never took the money out. But is that how I use this policy? No, a second ago I told you I've used this to buy cars, pay off debt, cover payroll. I've used this to flip houses and loan money. I've used this every single year. So a cumulative return would not be the right return, right? Right. A cash on cash return would be the right return to look at. You see, a cash on cash return would say how much I earned that year based on how much I put in. So we know I put in $4,407.50, and this year my net return was $3,655.62. So to figure out cash on cash return, all you would do is you would take your net return, $3,655.62, and divide it into the amount I put in that year, $4,407.50. Now that number that you got, which is 82.9%, is your cash on cash return. In other words, if you put $4,407.50 in, how much did my $4,407.50 give me that year? Well, it's an 82.9% year in the 16th year. How much was it the year before? Well, this is pretty interesting. So if we go back the year before, my cash on cash return was 63.11. So in 1 year, this stupid whole life insurance policy has gone from 63.11 cash on cash to 80.9% by the math. And my cumulative return, I think I did that, yep. My cumulative return in 2023 was 17.5, and now it's 28.2. Just the policy, folks. I have used this policy to make a lot more money than those kind of returns in lending and paying off debts and buying cars and all that. Every single time I use the money, I'm making money twice because I'm making this cumulative return and I'm making this cash on cash return, whether or not the money's in the policy. And the only thing I need to do, if I take loans from the policy, I need to factor out the loan interest rate that the insurance company charges. Now, this New York life policy, every year except for the last 2 or maybe 3 years, it was always 4%. So when I would borrow from the policy, I would borrow at 4%. Okay, but now it's I think 5%. I don't hold me to that, but I'm pretty sure my borrow rate is 5%. So the whole time I've had this policy, I've been able to borrow money from the policy between 4 and 5%, which arguably is a pretty low interest rate, right? I've been able to borrow at 4 to 5%. But I made 28. But I didn't really make 28 if I borrowed from it. I'd have to subtract the 4 or 5 from that. And I didn't actually make 82.9%. I'd have to subtract the 4 or 5% to that. Are any of you picking up what I'm putting down? Would it even matter if you had to give the insurance company 4 to 5% when you made 82.9 this year? Would it really matter if you had to give the insurance company back 4 to 5 if you made 28.2? No. Because I earned uninterrupted compounding interest on this policy. Just like your old whole life policies earn uninterrupted compounding interest. Now, not all whole lives are the same. Now, let me put a pin in this policy and let me just kind of explain something that's really important. And you can call your insurance company who your policy is with and ask them this. Ask them if it is a non-direct recognition company or a direct recognition company. Now, I know that seems complicated, but let's just Google this because Google helps a lot. Right here in Google, just put in non-direct recognition versus VS direct recognition life insurance. And that'll give you an explanation, but it's quite simple. Just like it says, non-direct recognition, which this policy is, and all the policies we use with the exception of Guardian are all non-direct recognition, which means they do not recognize the loan when you take it. So therefore, your cash value, all 90,000 of my cash value is able to grow with interest and dividends right here, guaranteed or base plan guaranteed cash value increase and dividend. Those grow and they don't get affected by the loan. Now, a direct recognition life insurance would be directly affected by the loan because the insurance company directly recognizes the loan, which means when you take a loan from a direct recognition company, they're going to adjust the amount that you're earning dividends on by the amount of the loan. Now, All the companies play this game a little different, so I'm not going to get into that, but just understand non-direct recognition versus direct recognition, and you want a non-direct recognition company. Now, if your policy is not non-direct, that doesn't mean you can't use it. Just make sure you're practicing the infinite banking concept the right way. In other words, as R. Nelson Nash said in his book, Becoming Your Own Banker, don't steal the peas. Never ever steal from your bank. If you take a loan from your bank and you pay off a Visa that was $100 a month, pay your policy back $100. Don't steal the $100. Because you took the money from your policy, repay your policy loan. Got it? But all I wanted to do in this video is really just show you that even an off-the-shelf whole life insurance policy can be incredibly useful for you when it comes to private banking. It can be incredibly useful for you in using the infinite banking concept to take back the banking functions in your life. I'm living proof. This is just one of many policies I own, but this is the only one, well, I'm sorry, I have 2 New York Life policies like this, but those are the only policies I own that are not specially designed and engineered. And they still work this well. What does that prove? It proves that the base part of a whole life in the long run is the most efficient thing you will ever put money into. So it basically debunks everything you've heard about 90-10 designs, if you've heard about them, being better. They are not better because less money goes to the base, which means in the long run, they're not as efficient as these policies. So folks, I still would say, if you were going to start the infinite banking concept with us, you would want a specially designed and engineered whole life policy because you'd want that high early cash value. This policy and the old policies that you all have, you probably know there was no cash value to be used in the first year, none in the second year, and barely any in the third year. I'm 16 years in. So I certainly would never design a policy like this for you because this would not be efficient in the early years for the infinite banking concept. But in the later years, they're awesome. So folks, if any of you have an old whole life, pull out your statement, call the company, get an in-force illustration, run the math like we just did, and you'll be quite surprised at how amazing these old whole life policies really are. And the only thing you need to do is start practicing the infinite banking concepts with that old policy. Folks, I hope you've enjoyed this video, and if you like this one, check this video out right here. It's the remastered 90-minute money multiplier video. You will love it. The secrets of the rich is what I call it. Check it out, and we'll see you on the next video.